Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
I want you to try a little visualization with me. If you're driving, obviously, keep your eyes on the road, but just picture something massive. I mean, truly enormous, like a sprawling offshore wind farm in the North Sea. You know, hundreds of turbines spinning in the mist. Looks like something from a sci-fi movie. Or maybe a data center the size of 6 football fields.
Right, humming away with servers that could power a whole city.
Exactly. These are the titans of the modern world. We drive on them. We get our power from them.
Our entire digital life runs through them.
It does, and they're amazing feats of engineering. But whenever I see these things, the question that always nags at me isn't about the concrete or the steel. It's the money. How on earth does a company actually pay for that? We're talking billions of dollars. You don't just put a new international airport on the corporate Amex.
No, you definitely do not. And honestly, you usually don't even use a standard bank loan, not in the way, say, a small business would understand it.
And that's what we're digging into today. We've got a stack of research here on a topic called project finance. And I know that sounds maybe a little dry, like an accounting term.
It does.
But when you actually peel back the layers, it's this incredibly high stakes, really clever financial engine. It's basically the operating system for building the physical world.
It really is. Our mission today is to unpack how companies fund these massive investments without betting the entire farm. We're going to look at the mechanics of risk isolation, which is really the secret sauce here. And we'll get into the waterfalls of cash that dictate who gets paid and when.
And we've got some fascinating case studies in the notes, too. We'll see why this works so perfectly for things like wind farms. And then we'll look at the other side, what happens when the model breaks, like with high-speed rail or what happened during the Texas winter storms.
Oh, that Texas example is just a brutal lesson in what happens when your spreadsheet meets a very cold reality.
So let's dive in. The core problem here seems to be about scale and risk. If I'm the CEO of a major energy company and I want to build $1 billion power plant, why can't I just borrow the money? I mean, my company's huge. I have good credit.
You could, theoretically. That's just called corporate finance. You borrow the money and your company's on the hook to pay it back. Simple as that.
Okay.
But just think about the risk profile for a second. These huge infrastructure projects, they take years to build. They're incredibly capital intensive. What if construction gets delayed by 2 years? What if the technology, fails? What if environmental regulations change halfway through?
If I borrowed that money directly, all those failures would drag down my entire company.
Precisely. If you fund a massive failure on your main corporate balance sheet, you might not just lose the project. You could actually bankrupt the parent company. You risk the healthy parts of your business to build this one new thing.
So project finance is the solution to that anxiety.
It is. The definition we're working with here is that project finance is a structure where the lenders and investors are repaid primarily from the cash flows of that specific project.
Not from the parent company's general bank account.
Exactly. Not from their general coffers.
Okay, but how do you actually separate them? I mean, legally speaking, how do you tell a bank, lend money to this project, but don't look at me?
You create a clone, well, sort of. You create what's called a special purpose vehicle, or an SPV.
I always love that acronym. It sounds like something NASA uses on Mars.
It's a little less exciting than a rover, maybe, but financially it's much more powerful. The SPV is a separate legal entity. It's created just for this one specific project. It has no history, no other employees, no other business. Its only purpose is to build and operate, say, this one wind farm.
So the SPV owns the assets, the actual turbines.
It owns everything. It owns the turbines, the land rights, the permit. It signs all the construction contracts. And most importantly, the SPV is the entity that borrows the money.
Which brings us to the term that seems to be the absolute linchpin of this entire industry, non-recourse debt.
Those are the magic words. Non-recourse, or sometimes you'll hear limited recourse.
To me, non-recourse sounds like no consequences, which sounds a little too good to be true.
Well, it's not no consequences in general, but it means no consequences for the parent. Think about a mortgage. If you default on your house, the bank takes the house.
Right.
But if the house isn't worth enough to cover the loan, in a lot of places, the bank can come after your other assets, your savings, your car.
Your wages. They want their money back, period.
Exactly. That's recourse.
Yeah.
In non-recourse project finance, if that toll road SPV goes bust, The lenders can take the keys to the toll road. They can take whatever cash is in the SPV's bank account. But, and this is the absolute key, they cannot cross that firewall to the parent company.
So they can't touch the parent's headquarters.
Nope. Or their other profitable power plants,
Right.
or their main bank accounts.
That is a massive shield for the sponsor, the company building it. It essentially caps their downside. The most they can lose is the initial money, the equity they put into that one SPV.
It's what we call off-balance sheet financing. It lets a company attempt a huge, risky project without totally ruining their credit rating or threatening their existence.
Okay, I get why the CDO loves this. It's heads I win, tails I don't lose everything, but
Yeah.
I'm struggling with the other side of the table. Why on earth would a bank agree to this? Hey, lend me $1 billion, but if it all goes wrong, you can't sue me. That sounds like a terrible deal for the lender.
It does sound risky, doesn't it? And it is. But this is where the discipline of project finance comes in. Because the lenders have no safety net, because they can't go after the parent, they become absolutely obsessed with the project itself.
They stop looking at the borrower's general credit score and start looking at the project's actual business plan.
They scrutinize every single detail. I mean, they act almost like a second set of engineers and auditors. They check the construction contracts, the environmental studies, the demand forecast for traffic on a road. They force a level of discipline that is just incredibly strict.
And they structure the repayment in a very specific way.
They do. Which brings us to the cash flow waterfall.
I saw this diagram in the notes, and it's surprisingly rigid.
It has to be. The waterfall is the hierarchy of who gets paid and in what order when money flows into the SPV. So imagine the revenue from the toll road. It hits the top of a bucket. It doesn't just get distributed randomly. It flows down a strict list.
So walk us through the tiers. Who drinks first?
Priority number 1, operating expenses, OPEX. You have to keep the lights on.
Makes sense.
If you don't pay the staff at the toll booth or the maintenance crew fixing the potholes, the project stops making money and then nobody gets paid. So OPEX is sacred.
You can't kill the goose that lays the golden eggs. Okay, who's next?
Priority number 2 is debt service. This is the bank getting their principal and interest. They get their cut before almost anyone else.
Okay, so the bank makes sure they're right near the top of the list.
Correct. And then after them, you usually have priority number 3, reserve accounts.
This is like a mandatory emergency fund.
Exactly. The lenders will often require the SPV to stash money away for future major repairs, like replacing a turbine blade in 5 years, or for a debt service reserve account.
Which is what?
It's basically 6 months of loan payments sitting in cash, just in case revenue dips for a little while.
So the bank is protecting itself against a rainy day before the owners even see a dime.
That's the rule. And then finally, at the very bottom of the waterfall, strictly last in line.
The owners.
Equity distributions. This is the profit for the parent company or the investors who put up the initial capital.
That paints a very different picture. The parent company is protected from bankruptcy, sure, but they are also dead last in line for the cash.
That is the trade-off. If the cash flow from the project dries up just a little bit, the bucket at the bottom stays empty. The bank might still get paid, the lights stay on, but the investors get zero.
It puts a tremendous amount of pressure on the accuracy of those initial cash flow predictions.
It does. And the lenders monitor this with a very specific metric called the DSCR, the debt service coverage ratio.
Unpack that for us.
It's just a measure of the buffer. So mathematically, it's the cash flow available for debt service divided by the debt service that's due. So if you have, say, $150 coming in that's available, and you owe the bank $100.
Your GSCR is 1.5, is that good?
1.5 is pretty decent. That means you have a 50% buffer. If that ratio drops too low, say down to 1.1 or 1.05 covenants and the loan kick in, the lenders can actually step in, lock the bank accounts, and block any money from going to the owners until that ratio is healthy again.
What do they call that?
It's called a cash trap.
A cash trap. So that sounds painful for the equity holders.
It's designed to be. It forces the operators to fix the problem immediately.
So let's look at the big picture then. We've got risk isolation for the parent, but this super strict discipline from the bank. Why do companies go through this headache? Is it just about that risk shield?
That's reason number 1 for sure. But there are a couple of other big drivers. One is leverage. Because the bank is looking at the project's cash flow, not the company's overall health, you can often borrow more money, get higher leverage, than you could with a normal corporate loan.
So you can build more with less of your own money up front?
Exactly. And the third reason is the type of investor you attract. There are these massive pools of capital out there, pension funds, insurance companies, sovereign wealth funds.
Right.
These guys have trillions of dollars, and they need safe places to park it for, 30 years.
They aren't looking for the next crypto spike. They need to pay retirees in 2050.
Correct. They want boring, steady, long-term returns. And project finance packages these big infrastructure assets into a product that fits perfectly into a pension fund's portfolio.
Yeah.
It turns a bridge into something that looks and feels a lot like a bond.
Let's look at who's doing this well. The notes highlight Ørsted as a prime example. They're the kings of offshore wind.
Ørsted is a fascinating case. They've basically transitioned from being an oil and gas company to a green energy giant. And they did it largely using this structure. They set up SPVs for their wind farms all across Europe, the US, Asia.
But wind seems risky. I mean, the wind doesn't always blow. How do they convince a bank to lend billions on something so variable?
That is where the revenue risk mitigation comes in. They use something called a power purchase agreement, or a PPA.
We hear that term a lot in energy news. How does it fit into the finance structure?
A wind farm has huge upfront costs to build, but once it's running, the fuel, the wind, is free. So the main risk is the price of electricity. If the price crashes in 5 years, the project fails. So Ørsted signs a contract, a PPA, usually with the government, or a massive utility company. This contract guarantees a fixed price for every megawatt hour they generate for, say, 15 or 20 years.
So they are locking in the revenue side of the spreadsheet before they even break ground.
Exactly. The lender looks at that contract and says, okay, the government of the UK has promised to pay X amount for 15 years. That is a secure cash flow. That single piece of paper turns a risky wind farm into a secure annuity.
It just removes the market variable from the equation.
It does. And then you have companies like Brookfield Infrastructure Partners. They are absolute masters of this game. They focus on what we call essential infrastructure. Toll roads, ports, data centers.
Most people have to use.
Stuff where you have a monopoly, or at least a near monopoly. And Brookfield loves assets that are inflation-linked.
Explain that.
Well, if you own a toll road, your contract with the government often allows you to raise the tolls every single year based on the inflation rate.
Yeah.
So if inflation goes up, your revenue goes up automatically. But your biggest cost paying back the debt is usually a fixed number.
So inflation can actually widen your profit margin.
It can, yes. And that's why Brookfield's portfolio is so attractive to those pension funds we were talking about. It's an inflation hedge.
Then there's Macquarie Group. They do a lot of airports and roads, but the notes mention they sometimes take on volume risk.
This is a bit spicier. Unlike the wind farm with its guaranteed contract, a toll road might rely on how many cars actually show up.
Which is much harder to predict.
Much harder. But Macquarie is famous for their modeling. They analyze traffic patterns, population growth, alternative routes. If they get it right, and the traffic is just steady and boring, it's a cash machine.
But if they get it wrong, that brings us to the dark side. Because project finance doesn't eliminate risk, does it? It just moves it around.
It concentrates the risk. And when the modeling is wrong, or when something unexpected happens, things get ugly very fast.
The notes outline 3 big monsters that keep these bankers up at night. Let's walk through them. Monster number 1.
Construction risk. This is the classic mega project problem. Will it actually get built on time and on budget? If you're building a nuclear plant or a tunnel through a mountain, delays are almost inevitable.
And in project finance, time is literally money.
It is. Because during the construction period, you're paying interest on all that debt, but you have zero revenue coming in. If the project is delayed by 2 years, your interest bill explodes and the SPV can run out of cash before the doors even open.
So how do they kill that monster?
Usually with fixed-price contracts, they make the construction company sign a document saying, I will build this for $1 billion, and if it costs $1.2 billion, that extra $200 million comes out of my pocket, not the SPVs.
You pass the buck. Okay, monster number 2.
Demand risk. We just touched on this with the toll road. Will people actually use it? Will companies lease the servers in the new data center? If your spreadsheet says 10,000 cars a day and only 5,000 show up, you breach that DSCR ratio we talked about.
And the bank takes the keys. And the third monster.
Regulatory risk. This is the one you can't really model for. What if the government just changes the rules of the game?
This feels like a perfect setup for our first failure case study, the California High-Speed Rail Project.
A textbook example of how these project finance principles can fall apart when the foundation is shaky.
The sources describe this as a kind of death by uncertainty. What went wrong?
It was really the trifecta of risk. You had massive cost overruns, that's construction risk. You had huge delays in permitting, that's regulatory risk. And because the political winds kept shifting, support from one governor, skepticism from the next, the long-term commitment just wasn't there.
And banks hate uncertainty.
They are allergic to it. In a normal project finance deal, you need certainty to get that cheap non-recourse debt. You need to know that the environmental permit you have today is still going to be valid in 10 years. California couldn't offer that stability.
So the private capital just stayed away.
Largely, yes, which forced the state to rely more and more on public funding, which then becomes a political football, which creates even more uncertainty. Yeah. It's a vicious cycle. It shows you can't just wish a project into existence. The math has to work to unlock all that private money.
It's a stark reminder that idealism doesn't pay the interest on the loan.
Mm-hmm.
But sometimes the math works just fine and the world just breaks. I want to unpack the Texas power plants during Winter Storm Yuri in 2021. This was a fascinating stress test.
Yeah, this was a really complex failure. It wasn't just that the grid went down. It was a failure of the financial hedging strategies that were supposed to protect these projects.
Intuitively, I would think. I own a power plant. It's freezing. Everyone needs heat. Prices are spiking. I should be making an absolute fortune.
You would think so.
Yeah.
And the spot prices for electricity did go to the moon, something like $9,000 per megawatt hour. But here's the trap.
Okay.
Many of these independent power projects had already signed contracts promising to deliver power. They had sold their output in advance to be safe.
To keep the bankers happy with that steady, predictable revenue.
Exactly. They hedged their bets. But then the storm hit. Gas pipes froze. Instruments on the plants froze. The plants couldn't generate the power they had promised, but they were still legally obligated to deliver it.
Oh, I see where this is going. They had to go into the open market and buy it.
Yes. They had to buy power at $9,000 to fulfill a contract where they were selling it for maybe $40.
That is catastrophic. It sounds like a financial black hole.
It's a short squeeze on a physical asset. It completely wipes out the cash flow of these SPVs in a matter of days.
And because they are SPVs,
the money just ran out. They couldn't meet their debt obligations. The waterfalls dried up completely. The sources we looked at mentioned that projects with weak force majeure clauses, the act of God protection, they couldn't save themselves.
So even though the parent companies might have been huge, stable energy firms, the specific SPVs for those individual plants went under.
Correct. It was a brutal reminder that you have to stress test for the black swan events. You can't just model for the average winter. You have to model for the 100-year storm. If your downside protection isn't robust enough, the discipline of the market is unforgiving.
That leads us to the implications of all of this. I mean, most of our listeners aren't financing toll roads or negotiating billion-dollar wind farms. Why does understanding this financial architecture matter to the average professional?
I think it changes how you look at risk in any business. Even if you're just launching a software product or opening a new branch office, the discipline of project finance is a really powerful mental model.
Just asking that question, where does the risk actually sit?
Exactly. Is the risk isolated, or is it contaminating the whole business? And look at the cash flows. Are they resilient? Do you have a waterfall in your own budget? Are you paying the essentials first, or are you just hoping for profit before you've covered your downside?
It forces you to be honest about your assumptions.
It strips away the optimism bias. The bank doesn't care about your vision, they care about your DSCR. Adopting a little bit of that ruthless banker mindset can save a lot of startups and internal projects from failure.
And looking at the macro picture, it seems like project finance is really the enabler of the big transitions we're going through, whether it's green energy, digital infrastructure, or modernizing transport.
It aligns capital with long-term value. We have trillions of dollars in pension funds needing a home, and we have a planet that needs rebuilding. Project finance is the bridge that connects those two things. It allows society to build these massive, necessary things by compartmentalizing the risk so that no single failure brings down the whole system.
It's pretty amazing when you think about it. We drive past these things every single day, bridges, cell towers, solar fields, and we never think about the legal force fields that are built around them.
It really is the invisible architecture of the economy.
I think that is a perfect place to wrap up this deep dive.
I agree.
So to recap quickly, project finance isn't just a loan, It's a whole structure. It uses an SPV to isolate risk.
It relies on non-recourse debt so the parent company stays safe.
And it uses a strict cash flow waterfall to make sure the lenders always get paid first.
And importantly, it relies on the project's own merits to survive. No corporate bailouts. It has to sink or swim on its own.
Here is my final thought for you to chew on today. The next time you're driving over a toll bridge or you see a wind turbine spinning in the distance, stop for a second and ask yourself a question. Is that structure standing there because a politician decided to pay for it? Or is it standing there because a spreadsheet proved to a bank that it could pay for itself?
That is the multi-billion-dollar question.
Thanks for joining us on the Deep Dive. We'll see you next time.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.